Welcome to the Deep Dive. Today we're diving into digital assets and why this matters for everyone, not just the Wall Street gurus.
We're talking about a potential tidal wave of change in finance, and getting ahead of it is key for, well, everyone.
Okay, so digital assets. Most people hear that and think Bitcoin, end of story. But it's way bigger now, right?
Absolutely. Think of anything valuable, but instead of a physical thing, it exists digitally on a blockchain, like turning a stock certificate into a easily traded digital version. That's tokenization.
So not just digital money, but digital everything of value. Got it. But why are the big institutions suddenly so interested?
Scale. One study projects tokenized assets could be worth over $10 trillion by 2030. That kind of money gets attention.
It's not just talk, though. We're seeing this play out in the real world.
Exactly. The U.S. Treasury, for example, over $1 billion of their stuff is already on the blockchain. The European Investment Bank is issuing its own digital bond. And Hong Kong, they're going all in with that multi-currency digital bond, pulling in investments from big asset managers, banks, even insurance companies.
So real money, real fast. Why the urgency? Is it just fear of missing out or something more?
There's always some FOMO with new tech, but this is about tangible progress. Blockchain technology itself is maturing incredibly quickly. We're seeing breakthroughs like Layer 2 scaling, which makes transactions faster and cheaper, and zero-knowledge proofs, which boosts privacy without sacrificing transparency. This stuff is making blockchain viable for the big leagues.
And with the tech improving, we're seeing regulations trying to catch up, which big institutions always need.
For sure. Regulatory clarity is make or break for institutions. It's still early days, and the rules are all over the place, but governments are definitely paying attention now. The UAE just set up a whole regulatory authority for virtual assets. Hong Kong, on top of their digital bonds, have clear guidelines for how digital assets need to be stored safely.
Taming the Wild West, bit by bit.
Exactly. That, plus the potential for diversification, makes digital assets hard to ignore.
Diversification, everyone wants that magic ingredient for their portfolio.
Think about it, digital assets, especially crypto, haven't moved in sync with traditional markets historically. So if the stock market tanks, your digital holdings might hold steady, maybe even go up. Not a guaranteed win, but it adds a layer of protection that's hard to find elsewhere.
So like an insurance policy for your investments?
In a way, yeah. But, and this is key, it's still early innings. Research and understanding the risks is absolutely crucial.
So it's not just about buying a bunch of Bitcoin anymore. How are these institutions actually getting involved?
It's gotten a lot more sophisticated, that's for sure. Remember those spot Bitcoin ETFs we talked about? Huge inflows recently. And now, with spot Ether ETFs launching too, that's a big signal. They did over $1 billion in volume on day one.
And Hong Kong's jumping in with their own approvals. Seems like everyone wants a piece of that ETF pie.
ETFs are just one piece of it. Private equity and venture capital firms are pouring money into the whole digital asset space. We're talking blockchain infrastructure, decentralized finance platforms, even those NFT marketplaces. It's like the Wild West of the early internet all over again. Everyone's looking for the next Google or Amazon of the blockchain world.
So not just owning Bitcoin, but investing in the whole system around it.
Exactly. And within all that, we're also seeing more complex stuff popping up, like crypto derivatives. These let institutions hedge their bets, manage risk, maybe even profit from how much the market swings up and down. And then there are stablecoins.
Stablecoins, right. Those are pegged to something stable like the US dollar, so they're less volatile.
Exactly. That stability makes them really interesting for things like cross-border payments, potentially much faster and cheaper than traditional methods. And we can't forget NFTs. They started with digital art, but now they're being used for supply chain tracking, intellectual property rights, all sorts of stuff.
NFTs like a digital certificate of authenticity. That's wild. With so many choices, how do institutions even begin to pick where to put their money? Seems risky.
That's where that diversification we talked about comes in, and really understanding what the investor wants to achieve. Digital assets, especially cryptocurrencies, they haven't really moved in the same way as traditional markets. That means if the stock market takes a nosedive, your digital holdings, they might not even flinch. Could even be a good buffer.
That's got to be a big deal for anyone worried about risk.
Huge. But, and this is important, just because it's happened that way before, it doesn't mean it'll always work like that. Digital assets are still new, still volatile. What worked yesterday might not work tomorrow. Due diligence, risk assessment, those are non-negotiable. You wouldn't buy a house without checking it out first, right?
Yep.
Same principle.
So a balanced approach, do your homework, and know how much risk you can stomach. Same as any investment, really.
Absolutely. And not all institutions are jumping in head first. A recent survey by PwC, they found over half of traditional hedge funds not planning to touch cryptocurrency in the near future.
Really? I thought everyone was catching crypto fever.
Some are, but others are waiting to see what the regulations do, get a better grip on the risks involved. That being said, the same survey found that a good chunk of those hedge funds, they see tokenization as a huge opportunity, like really huge, disrupting traditional finance, kind of huge. Intrigued, but dipping their toes in cautiously.
So healthy skepticism alongside the hype.
You got it. And one of the biggest things institutions worry about is custody. When you're talking about something that only exists digitally, how do you keep it safe?
Good question. And that takes us to our next big topic, the custody conundrum, and why it should matter to anyone, not just the big players. It's like we're talking about digital gold, but even gold needs a safe place to be stored, right? What are the risks when we talk about custodying digital assets, and why is this such a big deal, especially for those institutions with tons of money on the line?
That's the heart of it. Blockchain is super secure, but only as strong as its weakest point, right? And that weak point, a lot of the time, isn't even the tech itself. It's us or the systems we create around it. We've all seen the headlines, exchanges getting hacked, people losing their keys, or just falling for scams. Custody is all about reducing those risks, about building that digital vault for your assets.
Okay, so say I want to buy my first piece of digital, whatever, maybe some of that tokenized artwork we were talking about. What are my options for actually holding on to it safely?
You've got a few, each with their own pluses and minuses. The one everyone knows is self-custody. You hold your own private keys. Imagine it like cash in your wallet. Total control, total responsibility. This is usually done through what we call wallet, which can be a little device, or software.
Right, the wallets. I've heard those can be hot or cold. Is this just about if my computer's getting warm?
Not quite. It's about how secure they are. A hot wallet is always connected online. Easy to use if you're doing transactions a lot, but also easier to hack, like carrying cash in your pocket, convenient but risky. A cold wallet that's offline, often a separate little gadget. More like a safe at home for your savings, way more secure, but less convenient to access.
So, more security usually means more hassle, too. What about those of us who'd rather let the pros handle it?
That's where exchange wallets and third-party custodians come in. Exchange wallets are offered by, well, the crypto exchanges. Simple, especially if you're trading a lot. But remember, you're trusting them with your stuff. And we've seen exchanges get hacked, even go bankrupt, not good for your peace of mind.
Not your keys, not your coins.
Okay.
I've seen that one thrown around.
Exactly. That's why for institutions, especially when you're talking about huge amounts of money, third-party custodials are getting really popular. Companies that do nothing but keep digital assets safe. PwC found 80%, a whopping 80% of crypto hedge funds use them.
So like choosing the right bank, but for your digital fortune.
Exactly. And like banks, not all custodians are equal. The best ones are qualified custodians. That means they've got the regulations, the security measures. They often use things like multi-party computation wallets, super high-tech stuff.
Multi-part. Okay, that one sounds intimidatingly complex.
The name is fancy, but the idea is simple. Instead of one key to access the assets, think multiple keys held by different people. No one can mess with it alone. Way more secure, especially for those big sums we're talking about.
That's got to be reassuring, especially with all the money we're talking about. But this just highlights how new all this is, especially on the regulatory side.
Oh, absolutely. It's been like the Wild West, but thankfully we're seeing things move in a good direction. The UAE setting up that whole regulatory body just for virtual assets. Huge. And Hong Kong, with their custody guidelines, the ETF approvals, they're making moves to be the place to be. That regulatory certainty is what institutions want to see.
And then there's the EU's MiCAR. Right.
Yeah.
A big deal for getting everyone on the same page.
Huge. MiCAR is a game changer because it sets the standard across different countries. It's leveling the playing field, making the whole scene more stable for big investors. But even with all that progress, there are still some big question marks.
Like what? What are the biggest things that still need to be worked out?
How to define these assets, for one. The lines are blurred, especially with things like fiat currencies on a blockchain. Is it still a currency, or is it an asset now? Big implications for taxes, for reporting, crucial stuff for big investors.
Taxes, everyone's favorite topic.
Right. And then there's the whole cross-border thing. Digital assets, they move across borders super fast. That speed makes it tough to regulate, especially when you're trying to share information, stop illegal stuff. The Financial Stability Board has some ideas, but it's a work in progress for sure.
And we can't forget about those stable coins. meant to be stable, but still bring their own set of challenges when it comes to regulating them.
For sure. Singapore's ahead of the curve on this one. They've got a proactive system for regulating stablecoins. Things like making sure the issuers actually have the money to back them up, clear rules on custody. Their model could be really useful for other countries trying to figure this all out.
There's so much going on, changing all the time.
Definitely. That's why, on top of all the regulatory stuff, we're seeing some really advanced risk management tools and strategies popping up. Just for digital assets, traditional risk management, it's not enough anymore. Institutions need to step up their game.
So it's a two-pronged approach. Navigate the regulations and come up with new ways to handle the risks that come with this new asset class.
Nailed it. One strategy is taking those old-school value-at-risk models, VAR for short, and adapting them. They're usually used to figure out how much a portfolio could lose, but now they're being tailored for the wild world of digital assets. Rigorous scenario analysis and stress testing are crucial, too.
Stress testing, like seeing what happens if the market crashes.
Exactly. But you're also stress testing for things like cyber attacks, even what happens if the regulations change. Since this digital asset market is so new, we don't have tons of historical data. That's where reverse stress testing is useful.
So instead of looking at the past, you're trying to figure out what could happen in the future.
Exactly. Start with the worst case scenario, like a major exchange going belly up or a huge security flaw in the blockchain itself. Work backward from there, figure out what could lead to that and how to prevent it.
Being proactive, not reactive.
Yeah.
Smart.
And to manage risk even better, institutions are getting really good at using technology. We're talking machine learning to spot fraud in real time, keep an eye on any fishy transactions. And with DeFi becoming so big, people are making tools to audit smart contracts, those self-executing contracts that power a lot of DeFi. That helps minimize the risk of errors or vulnerabilities.
So, listener name, what have we learned today? Digital assets are complex, always changing. But as we've seen in our deep dive, it's an exciting world with a ton of potential. Big institutions are taking notice, and what they do will shape the future of how we all deal with money, really.
Knowledge is power, especially with investments. We've covered a lot what digital assets even OE, what's driving institutional interest, investment strategies, how to even keep these things safe, the regulations, and how to manage risk. It's a lot.
But the key takeaway, even though there's huge potential, do your research, understand the risks, and don't bet the farm without knowing what you're getting into.
We've talked about tokenizing almost anything, financial stuff, art, real estate. But here's something to think about. What about the stuff that's not so easy to pin value on? Intellectual property rights, carbon credits, as this all keeps developing, who knows what the limits are?
Fascinating stuff. We'll have to dive into that more another time. For now, keep exploring, keep learning, and as always, happy investing.